As we all know, in 2026, the yen experienced its most terrifying, uncontrolled freefall in nearly 40 years. It broke through 150 at the start of the year and then kept collapsing. By July, it had plunged to 164 yen to the dollar, hitting a record low not seen since 1986. The Japanese government was naturally extremely anxious. In just 1 month, the Ministry of Finance spent a record 11.73 trillion yen trying to rescue the currency. But that massive infusion didn't even make a ripple. It was instantly swallowed up by enormous carry trade selling pressure. Japanese citizens watched their purchasing power shrink day by day, while the Bank of Japan found itself in an impossible situation. Raising rates risked triggering a default on its huge government bond debt, but not raising rates meant watching the yen collapse and inflation run wild. Just as markets fell silent and everyone online was guessing when the yen would break 170.70, and Japan's economy would be in dire straits, the tide turned on the 31st of July. The US and Japan jointly bought yen. Japan's Ministry of Finance later confirmed that the operation was coordinated with the US Treasury, and the U.S. Treasury Secretary Bessent publicly stated that the U.S. would not rule out further intervention if necessary. This was the first time since 1998 that the U.S. had stepped in to buy yen. In fact, after the 2011 Great East Japan earthquake, the G7 also intervened jointly, but in the opposite direction, selling yen to prevent excessive appreciation. This time, however, the US was once again putting real money behind the yen bulls for the first time in 28 years. Before the action, the dollar-yen exchange rate had approached 164. Afterwards, the yen briefly surged to around 155, then settled back near 157. Within a few hours, Japanese social media was celebrating. Dad finally came through foodie only. Dad is good. Meanwhile, those in the forex market who had bet on further yen depreciation were momentarily bewildered. Wasn't President Trump always the one who hated it when others took advantage of the US? Why would he suddenly rescue the Japanese? But confusion lasted only an instant, as traders quickly realized, no matter, let's unite and double down suai, keep shorting the yen. After all, when the United States makes a move, it is unbeatable. Forex traders estimated, based on Bank of Japan settlement data, that Japan alone might have spent about $36.5 billion on just that Friday, with the previous day's unusual flows possibly reaching nearly $59 billion, meaning a total of roughly $95.5 billion over 2 days to buy yen. Of course, these are still estimates based on settlement data. The final figures will have to wait for official disclosure from Japan's Ministry of Finance. But history has repeatedly shown that the ministry's numbers are usually less accurate than traders' own back calculations. More intriguingly, according to trading information obtained by the Financial Times and Reuters, the US may not have used dollars to buy yen tools, it may have used euros. Selling euros to buy yen is highly unusual, perhaps even unprecedented. So the question arises, why is the US suddenly so concerned about the yen? We all know that a weaker yen hurts the Japanese the most, tie more expensive energy imports, pricier food imports, declining real purchasing power, and pressure on Prime Minister Takaichi's approval ratings. Logically, this is Japan's own currency, its own inflation, its own political problem. So why would the Trump administration get involved? Is Trump really planning to sing together with Japan? I think the opposite is true. The US is not stepping in to accompany Japan to the abyss. Rather, it has suddenly realized that Japan's economy is teetering on the edge of a cliff, ready to fall at any moment. And if Japan does fall, it could drag the US down with it. Today, we'll get to the bottom of this. Is the US really saving the yen, or is it saving its own tariff policy? Is Trump helping Takaichi, or is he protecting us treasuries? Is this intervention a genuine policy shift that can reverse the trend, or just a financial life support that buys the yen a few more months? Finally, let's go back to 1998 Fui, because 28 years ago, the US did almost the same thing. It seemed like a big victory at the time, but it ultimately failed to save the yen. Will this time be any different? Alright, let's begin the analysis. First, let's lay out the basic logic of this intervention. The so-called Join Us Japan Yen Rescue is not a press conference where they shout, the yen must not fall further. Real intervention means the two countries use other currencies to buy yen in the market. Japan's usual approach is the Ministry of Finance decides, and the Bank of Japan executes, by converting its dollar assets into dollar cash, then selling dollars and buying yen. This suddenly increases demand for yen in the market, and short sellers are forced to buy back yen to cut losses, causing the exchange rate to rebound sharply in a very short time. This time, the US joined in. According to the figures on Besson's to-do list, the Americans only bought about $5.10 billion worth of yen. Out of the estimated $95.5 billion total buying, Japan probably contributed $85.90 billion. But how much the US puts in doesn't matter as much as its signal su, because in currency intervention, the most important thing is never the size of the US purchase, but the strength of the signal that the yen should strengthen. If only Japan were acting, a typical trader would calculate how much foreign reserves does the Bank of Japan have? How much is Japan willing to burn to save the yen? How many days can that last? Japan intervened alone in April and May this year, but it didn't reverse the yen's depreciation trend. Most traders believe that Japan, excluding its US Treasury holdings, lacks the reserves to save the yen. The market might even see intervention as a better shorting opportunity. You push the yen up temporarily, and I'll sell it again at the high. But when the US wades in with its imposing presence, the deterrent effect is on another level. The US controls the world's most important currency. The dollar has the deepest financial markets, and through the New York Fed directly transmits policy intent. Once the US stands with Japan, the shorts are no longer facing just Japan's Ministry of Finance or central bank. They face the mighty financial empire of the United States Treasury and Federal Reserve. That heavenly army truly makes short sellers tremble. That is why even a relatively small coordinated US intervention may be just a note on Besson's pad. 40 can have an impact far exceeding the actual funds deployed. But why is the US willing to send such a strong signal? On the surface, the answer is Ali stability. A chronically weak yen raises Japan's import. Cost-style Japan is heavily dependent on energy imports, and food and raw materials also come largely from abroad. The weaker the yen, the higher the cost of living for Japanese households, the harder it is to improve real wages, the more fiscal subsidies the government must provide, and the greater the political pressure on Prime Minister Takaichi. For the US, Japan is not just an ordinary trading partner, Saiti, it is America's most important ally in Asia, bar none. A Japan beset by inflation, bond market woes, and currency crisis can hardly bear the security and strategic responsibilities Washington hopes it will shoulder. So geopolitically, the US does have reason to support Japan. No wonder Besant said the US-Japan alliance is not only military but also economic, and Trump quipped that the Japanese have incurred another huge debt to Americans, and they should bow in gratitude. But that is only the most superficial layer sai, and for Trump, it is essentially empty rhetoric. What really worries the US is that yen depreciation has begun to harm America's own interests, and specifically Trump's most prized policy, tariffs. If we ask what economic tool Trump loves most, the answer must be tariffs. Trump's logic is brutally simple. Foreign goods are too cheap. US manufacturing can't compete, so slap taxes on them. Soar raise import prices through tariffs, so domestic firms can regain competitiveness. But here is the catch. Tariffs are a price, and exchange rates are also a price. The problem now is that Trump has built a tariff wall at us customs, while the yen is digging a tunnel right under it. Some say the Japanese did this deliberately, sai. I don't think so because for Japan the cost is far too high. But whether intentional or not, here is the reality. Japanese goods entering the US get hit with tariffs, yet at the same time the yen is depreciating massively against the dollar. So a new logic emerges. Japanese exporters pay wages and buy parts with cheaper yen, but earn back more valuable dollars, giving them room to cut prices, compress profits, or even absorb part of the tariff cost themselves. In this way, the price Trump added at the customs door is substantially offset by the exchange rate on the other side. That explains why the US government has recently been loudly calling the yen seriously undervalued. From Trump's perspective, this is not an abstract monetary issue thud. It is a trade policy Pearl Harbor by the Japanese. So the US is using tariffs to pressure Japanese firms to raise their US selling prices, while worrying that if the yen falls to 170 or 180, a ridiculous outcome could emerge. US consumers bear the tariff-driven price increases, but Japanese exporters regain huge competitive advantages due to the weaker currency. The result would be rising inflation in the US, while Trump's genius tariff protection magic loses much of its effect and may even backfire. In a sense, the yen is undermining Trump's tariff policy. That is also why the US chose to sell euros to buy yen, rather than directly selling dollars. If the US sold dollars massively, markets would interpret it as the Trump administration deliberately weakening the dollar's cipher day. Broad dollar decline would make us imports even more expensive, and tariffs were already pushing up some import costs. Combined with a weaker dollar, US inflation pressure could rise further, limiting the Fed's room to cut rates, so the US wants to do something delicate, make the yen appreciate, but without making the whole dollar system look like it is being shorted by America. Hence, Secretary Bessent chose an unconventional route: sell euros, buy yen too, performing a localized financial surgery. This directly lowers the euro against the yen, lifts the yen, but avoids sending an overly strong policy signal on the dollar's main line, which cannot be touched. Bessent's plan is clever, but it has a big limitation. The US has very limited euros on hand that can be flexibly deployed. According to public estimates, the Fed and Treasury accounts hold only about 26 billion euros in immediately usable euros. That means the euro bullet can create a little exchange rate shock, but cannot sustain an indefinite currency war. If the yen's fundamentals don't change, the US will eventually face a choice: either use more dollars directly or press Japan to change its own policies. But Japan's government debt-to-GDP ratio is already over 260%, and raising rates would instantly blow up interest payments, forcing Takaichi to resign a tough ask, but not impossible in American eyes. That brings us to an even more critical layer of this joint intervention: U.S. Treasuries. Besides the tariff, Pearl Harbor, the U.S. is intervening to protect its bond market. Earlier we mentioned that when the Bank of Japan buys yen, where does the money come from? From foreign reserves only. So traders constantly watch how Japan's reserves change. And Japan's reserves are not just dollar cash in a vault. A large portion is held in U.S. Treasuries and other dollar assets. As of the end of May this year, Japan held about $1.14 trillion in U.S. Treasuries, still the largest foreign holder. To be precise, when Japan buys $1 worth of yen, it doesn't have to immediately sell $1 worth of treasuries on the open market. Japan has cash, deposits, and other liquid instruments to draw on first of because selling treasuries is no joke. Last year, a Japanese trader who rashly sold treasuries mysteriously committed suicide the next day. But if intervention grows larger and lasts longer, dollar cash will eventually need replenishing, and Japan might then resort to selling some treasuries or using them as collateral for funding. That is exactly what the US dreads, because one of America's most vulnerable spots is long-term treasury yields. With high fiscal deficits and large bond issuance, the market constantly needs new buyers. If the largest foreign holder begins to liquidate treasuries to defend the yen, even a small portion of its holdings could amplify market sentiment. Japan is already the most manageable major foreign holder of US debt. Second place China has already sold down to $600 saving, $100 billion, and continues to sell intermittently. We all know that if treasury prices fall, yields rise. Higher yields mean more expensive borrowing for the government, harder corporate financing, higher mortgage rates, and pressure on stock valuations. So the chain of events looks like this. Trump doesn't really care whether Japan lives or dies. Sudi he might be fine with a rescue, but absolutely not if it means dumping us treasuries. That is why this time the two sides brought out a tool many had never heard of, the FEMA Repo Facility, Foreign and International Monetary Authorities Repurchase Agreement. Here is roughly how it works. Japan temporarily pledges its US treasuries to the Fed. The Fed lends dollar cash to Japan. Japan then sells dollars and buys yen in the forex market. When the repo matures, Japan returns the dollars to the Fed and gets back its treasuries. In short, in the past, Japan might have had to sell treasuries to get dollars to save the yen. Now the US has set up a pawn shop where Japan can pawn its treasuries, borrow dollars, pay interest, and avoid dumping them on the market. This internal recycling is mostly between the two of them, but it does have some market significance for the yen. The US essentially builds a detour around the treasury market for Japan, allowing Japan to keep defending the yen a while longer, while the US avoids a potential cornered rat fire sale of its own bonds. Besant even proposed expanding the facility's capacity. Under current design, eligible foreign official institutions can get up to $60 billion per operation, with a maturity of only 7 days. Renewable by extension towing, but it is a temporary liquidity arrangement, not permanent aid, and Japan has to keep paying interest towing like, using a credit card. Now let's look back at this US rescue of Japan. Suai on the surface, the US is providing blood to Japan, being a good guy. In reality, it is giving life support to its own treasury market. Born from the same root, why so eager to harm each other? Trump reached out to pull Takaichi back from the cliff, not because he feared she would fall, but because her other hand was clutching over $1 trillion in US treasuries. And if she fell, she might drag that $1 trillion down with her, crashing into the US itself. But if that were all, it would be fine. Unfortunately, treasury selling isn't the worst consequence of a yen collapse. There is an even bigger bomb, the so-called yen carry trade, which many experts prattle on about mysteriously. It is actually simple. The yen plays a special role as one of the world's most important funding currencies. For many years during Japan's lost decades, rates were extremely low. Even though the Bank of Japan raised its policy rate to 1% this June, a 31-year high, real rates remain low, with a clear interest rate differential versus the US and others, including China. So global investors do a classic, no-brainer trade. Borrow cheap yen, convert to dollars, and buy higher-yielding US treasuries, corporate bonds, stocks, or other risk assets. That is the yen carry trade. As long as the yen keeps weakening, this trade is very comfortable. The borrowed yen gets cheaper, the dollar assets yield more, and you profit from both interest and exchange rate differences. The problem is, the longer this spring is compressed, the more dangerous the rebound. If the Bank of Japan suddenly accelerates rate hikes, or the US and Japan jointly force the yen sharply higher, those who borrowed yen face losses to cut losses. They must sell dollar assets and buy yen to repay their debts. One fund doing that is nothing. If all global funds do it at once, you get a yen spike, risk assets sell off, more margin calls, and a chain reaction of more yen buying. So unlimited yen depreciation does not make the system safer. On the contrary, the weaker the yen, the more carry positions may accumulate. Eventually, a single policy shift could trigger a stampede, and it has happened before. Of course, this is not an official US justification, but from a financial stability perspective, the US has strong incentives to create a controlled squeeze in advance dining. Make some overly confident yen shorts pay a price, remind markets that the US and Japan have drawn a line. Rather than waiting until the carry trade balloons and then gets detonated by an unexpected rate hike or financial crisis. The US worries not only about the yen falling, but also about it rebounding violently after a long decline. So this intervention appears to stop a yen crash, but in fact it is also managing the speed of global financial deleveraging. The US wants an orderly yen recovery. Its biggest fear is the yen first collapsing uncontrollably, then skyrocketing vertically amid global liquidations, Neither scenario is good for America. At this point, we must ask the fundamental question. If the US is so afraid of the yen falling, why can't Japan just raise rates to save it? The answer is that Japan has options, but each comes with horrendous costs. Prime Minister Takaichi's government wants to stimulate the economy, expand investment, cut taxes, increase fiscal spending. Understandable politically, households are squeezed. Growth is weak, so the government wants to support incomes and demand to win votes. At the same time, Takaichi follows her idol, Abe's preference for easy money, because rapid rate hikes would hurt consumption, real estate, and corporate financing. But she also wants a stable yen, preferably stronger, to ease import inflation. So here is the problem. Expanding fiscal spending, keeping low rates, and maintaining a strong yen tuing. These three goals are very hard to achieve simultaneously over the long run. We can call it Japan's impossible triangle of political economy. If the government keeps issuing debt, cutting taxes, and spending while demanding the Bank of Japan keep rates low, markets will worry about fiscal discipline and inflation, and capital will keep selling yen. If the bank hikes sharply to save the yen, the exchange rate may get some support, but JGB yields will rise. Japan's massive debt won't all roll over at higher rates overnight, but interest burdens will increase year by year as old bonds mature and are refinanced. Meanwhile, banks, insurers, pension funds, and institutions holding JGBs will suffer bond price volatility, household mortgages, corporate loans, and asset prices will also take a big hit. If the government tightens fiscal policy and cuts spending, that directly hits voters and growth. So Japan's problem isn't that it lacks tools to save the yen tool. It is that it wants a stronger yen but is unwilling to fully accept the policy conditions needed for one. That also explains why pure forex intervention often has only short-term effects and cannot fundamentally solve the problem. The forex market trades trillions daily. Japan can throw tens of billions in one day and shock the shorts, and with us backing it can amplify the scare. But if rates haven't changed the next day, fiscal direction hasn't changed the third day, and inflation and growth expectations haven't changed a month later, the market will eventually ask the same question again. Why should I hold yen long term? Am I crazy? So to answer the question many have asked me after this joint intervention, what will happen to the yen from here? I personally see three broad possibilities. Scenario 1. The US and Japan intervene, but Japan does not change its policies. This is the politically easiest path for Japan, but the least convincing for markets. They can continue to step in at key moments, and as long as shorts don't dare build large positions, the yen may oscillate within a range for a while, even holding some psychological level. This approach can kill the trade, but it is hard to kill the trend. If EUS rates remain significantly above Japan's, and Japan's fiscal expansion continues, capital will still see higher returns in dollar style. Every intervention-driven yen rise may become a new opportunity to short. The outcome, the yen, temporarily steps back from the cliff, but as soon as intervention stops, it will resume its relentless decline. Scenario 2. Japan truly changes its policy mix. TSUDI, the Bank of Japan, accelerates rate hikes. The Takaichi government dials back fiscal expansion and convinces markets that it is willing to bear economic and political costs to stabilize the currency. That is the most reliable condition for sustained yen appreciation, but it is also the most costly path. Rapid rate hikes will certainly hit the JGB market, increase future debt service burdens, and likely weigh on growth food yen. In other words, Japan's government could be instantly blown up. Actually, that is not even the main point. The main point is that the whole asset allocation and business model that Japan has built over decades on low interest rates would have to be shattered and rebuilt. In other words, the medicine that could truly save the yen might simultaneously inflict severe side effects on Japan's fiscal and financial system, possibly killing it. This path is a life or death gamble. Japan would need true heroic leadership to pull it off. Scenario 3. The model now emerging SIMD. The US provides a financial backstop. Japan handles frontline intervention. They use FEMA and other tools to isolate treasury risk. and repeated actions aim to shift market expectations. This path looks more effective than Japan going it alone because traders and shorts can't easily determine at what level the US will step in, nor the scale of the next coordinated intervention. As long as this uncertainty persists, policy ambiguity persists, the cost of shorting the yen rises. But us support has boundaries. If saving the yen visibly pushes up US inflation, if the US must continuously deplete its foreign assets, if Washington finds that Japan only wants American money while refusing to change its own fiscal and monetary policies, opposition will grow in the US. The US can buy Japan time, but it cannot solve all of Japan's structural problems, nor will it let Japan's problems become America's. FEMA can delay the need to sell treasuries, but it can't give Japan infinite dollars. Coordinated intervention can slap shorts, but it cannot permanently fix the US-Japan interest rate differential. Trump cannot hold Takaichi forever see. He has a Congress and re-election to think about. The core is not how much money the two countries spend buying yen, but whether the time they buy with those billions can actually translate into real policy adjustments. And when that real adjustment day comes, it may be the day Japan's economy commits suicide. Quite absurd when you think about it. How did Japan's economy get to this point? Back in 1998, the Asian financial crisis was still spreading. Japan's economy was weak, its banking system was troubled, and markets lacked confidence in the government's stimulus plans and financial reforms. The yen kept depreciating, hurting not only Japan, but also putting new depreciation pressure on Asian currencies like the Korean won, Thai baht, and Indonesian rupiah. At that time, Japan was still a manufacturing powerhouse, so when the yen became cheaper, other Asian exporters lost competitiveness. They either had to devalue along with the yen or bear the double whammy of export losses and capital outflows. On the 17th of June 1998, the US finally acted. The US Treasury sold $833 million and bought yen, while Japan's Ministry of Finance did the same in large amounts. It was a coordinated intervention, much like the one in July this year. The immediate effect was, of course, dramatic subsidy from Tokyo morning to New York close. The yen gained nearly 5%. Short sellers took heavy losses, and the media hailed it as a strong US warning to markets. If everything had ended that day, we'd have a simple conclusion. The joint rescue worked. So Japan's real savior was Russia Sudi, otherwise the yen would have blown up sooner. But if it had blown up, then would Japan now be in less of a mess? It is all fate. Of course, today's yen is not the 1998 yen. Back then, the US stepped in boldly, the yen soared, markets cheered a successful rescue but 2 months later it was lower again. Ultimately, it wasn't the intervention that changed the trend, but Russia's fiscal irresponsibility. 28 years later, the US and Japan may have more money, more tools, and better coordination. But Japan's debt is many times larger, its policy contradictions deeper, global financial leverage more complex, and countless hidden Russians lurk in the shadows. Now Trump, the Superman, has caught Takaichi mid-fall. She won't die right away. But the real question is, can he hold on to her forever? Or how long is he willing to hold her? And is Japan itself willing to stand up on its own? Does it have the determination to risk death and rebirth? Maybe it does solve to invade others and gamble that it certainly has, but to reform itself Davi that it certainly does not. So what do you think Davi and the yen that wasn't saved? In 1998, Savi, can it truly be saved this time by Besant and Trump? Alright, that is all for today. Thank you and see you next time.